We need to go to stock picks. You're going with Aspen.
Yeah, Stephen, it's a company that the market loves and then hates. And, if the market expects something and they don't quite deliver it, then, you get a little bit of a tantrum. And I think that's what happened. The stock was over $250. They came out with results that if you actually unpacked it, I didn't think were that bad. Obviously, you had the heparin model change that sort of also skewed things, which I think is part of the problem. When you're operating in, 100 countries, you've got manufacturing operations all over, with different input prices from different currencies and a fairly complex model, and the products you produce are complex and the competitive landscape is very complex. The market, I think, battles with this one. When I listened to the results presentation, it was like a few years ago, the message that was coming out from management was one of, we've settled down, the business model has grown up, there's a lot of optionality, there's lots of capex that has been spent that hasn't generated an income. We've got spare capacity in Quebec on those lines, and that will generate a return. The margin's going to improve. It was really a positive message just for the share price coming down. So, I think if I look a year out and I say, well, to June 25, earnings forecast, I think is about $18.
Wow.
I can see 15-20% upside from here. And if I fast track then to June 26, and I believe the forecast, which I do, then there's considerably more upside. So I think it's a business that's actually looking a lot better. To me, it really has grown up, and I get the sense that the downside is actually quite limited, particularly if those margins improve, because it's a relatively predictable model in a lot of the products. So, yeah, I'm going to go with Aspen. I think in the mid-190s, it's looking really cheap.
Aspen looking good there. Willem, Afrimat.
Simon, you asked us earlier sort of what can we buy to get exposed to China. So I've been spending my morning sort of looking for something that hasn't reacted yet. And I sort of came across Afrimat. So apart from the fact that they have bought an iron ore mine about 2-3 years ago that will do well in sort of any sort of Chinese exposure, specifically to iron ore, they've got a strong management team, and specifically in terms of their cost and their metallurgy, they've got real moats, which means sort of their basic sort of business without the sort of expansion has done very well. And then looking around the JC, they're probably one of the best allocators. I think if you have a look at the combined sort of earnings growth due to acquisitions and without, they're one of the only ones where there's a marketable positive influence in terms of acquisitions. So they're prudish, they're focused on free cash flows, they have some moats in the business. And then as of this morning, last week, they are exposed to the Chinese sort of industrial metal sector, which sort of did really well for them the first year they bought it, when the rest of the economy was doing poorly and iron ore was floating $150. So that kicker stays there. And I think overall, good management team, decent valuation, sort of a simple long-term buy at current valuations.
Yeah, and of course, Lafarge South Africa, if anyone can turn that around, it's Andries van Heerden and his team. That's all for tonight. Stockwatch, thanks to our guest, Willem Oldewage from Nitrogen Fund Managers, Graeme Körner from Körner Perspective. Up next, The Close. Stay tuned.